Hello everyone, welcome to our discussion of Chapter 3. So now that we have an understanding of cost behavior, fixed and variable cost, and we actually have technology tools on how to split those things that we can't really tell from looking at them into the fixed and variable portions. So a mixed cost or things that we've got a good idea about how to do that, to dig out that behavior, to be able to predict the future. Now we're going to use some of that understanding, some of those patterns, to start to make decisions, to analyze choices and what we're going to do going forward. All right, so that's what we mean by cost, volume, profit analysis. It really is the relationship between revenue and costs and what happens when you increase or decrease, for that matter, the volume, how much you're making. And really it is tied to the idea that as you change volume to respond to customers, whatever, yes, you're going to change revenue and you're going to change certain costs, variable costs specifically, but you're not going to change other costs, those that are fixed. And so therefore, we are going to have some formulas, some mathematical tools that will help us see what those changes in volume will have as far as changes in profits. Ultimately, that's what we're looking at, that profit situation. What's going to happen to the amount of income we make. So, total revenues minus total costs equals operating profit, right? That's nothing new. All right, if you want to go horizontally, vertically, doesn't matter, same formula. Okay? So, if we were to come up with a formula for figuring out revenue, all right, it is the selling price per unit. So, what do you tend to sell it for? And we're going to, most of the time, assume that that's going to stay the same based on volume, meaning it's not going to be different for the first 10,000 we sell versus the second 10,000. All right. Now, that may not be entirely true sometimes, but it's the assumption we're going to make and the equation we're going to use. Times units of output produced and sold. And remember, there can be a difference between what is produced and what's sold, right? If we produce more than what's sold, then it's sitting in inventory. And if we're selling more than we produce, then we are, selling stuff we made last month or the month before that or something like that. But, so total revenue is specifically output sold times the selling price. The total cost, of course, is the variable cost per unit times the units of output, how many things we made, and add the fixed costs, because they aren't going to change, right? So we're going to derive a little move things around a little bit, okay, to come up with how to come up with the formula for profit. Remember, that's what we really want to know. All right? So, if we take our price minus variable costs, right, we're going to call that contribution margin in the next slide, times how many units we make. So, every unit, so if our price is $5 and our variable costs are $2 per unit, then every unit we make and sell is providing $3 of profit towards covering your fixed costs. Once you've covered your fixed costs, then you can make actual profit. All right, so that's why it's called contribution margin. It contributes to the fixed cost and then to the profit. So there's your definition: contribution margin, price per unit minus variable cost per unit. That actually should say contribution margin per unit. I know it seems extra words, but you can also, contribution margin can be looked at in total as well. But this definition is contribution margin per unit, which is price per unit minus variable cost per unit. So, an example. We have a Desert Adventures company. Sales are $220,000. That's 55 trips that we sold at a sales price of $4,000 each trip. Okay, so 55 trips, $4,000 each, 220. Multiply that out. All right. Our variable costs, right, there's the variable trip costs and other, together are $1,200 per trip. $900 for variable trip costs, $300 for other variable costs. We multiply that by 55, right? There's no inventory on a service like this, okay? So you have to sell and make the same amount. Okay, so we don't have any of those issues on this example. 55 trips times 900 is 49.5. 55 times 300 is 16.5. We collapse those, combine those to get 66,000. So the contribution margin total is 154,000. If you want to do it per trip, it's 4,000 minus 1,200, or 2,800, which is a little easier than the formula they gave below, but gets the same result. 4,000 my sales price minus variable costs, 1,200. Then you subtract your fixed costs to get your operating profit. All right, so those fixed costs would not be different depending on if we had 65 trips or 62 trips or that sort of thing. But we would expect our variable costs and other variable trip costs and other variable costs to change based on our volume by 1,200 together for each additional trip. Or if we have fewer trips, there'd be less. So one of the things we use this kind of thinking about is to figure out where we break even. And why that's important is if your business can at least break even, it can probably survive. If it can't break even, meaning it cannot cover its costs, then over time, you cannot sustain that business. You have to do something about it to change the business. And by analyzing fixed versus variable, we maybe can come up with a solution for situations where we're not breaking even, all right? Or we can project how much profit we are going to make, all right, in certain circumstances. But we want to reach that magical break-even point when you've covered your cost, because that means that we probably can survive. So the formula that I want you to remember, okay, is you take the fixed costs and divide it by the unit contribution margin. So using our example from our adventure trips, the fixed costs were $134,400. back on this slide. And our contribution margin per unit was $2,800. So we take 134,000 divided by 2,800 and we get 48 trips. That's how many trips we have to go on to break even, meaning just barely cover our fixed cost, no profit at all. All right? So that is the first kind of formula or tool that we want to use. We could say, any year that, any month, maybe depending on whether this is a month or a year, I think this is a year, okay? Any year we don't go on at least 48 trips, we're going to lose money. That's what this is telling us. Now, contribution margin can also be looked at as a contribution margin percentage, sometimes referred to as a contribution margin ratio. And basically, that's taking the contribution margin and dividing it by the sales price. So if you're using per unit, you could do a contribution margin of $2,800 divided by $4,000 for the sales price equals 0.7 contribution margin ratio, or 70% contribution margin percentage. Whichever you prefer, whichever makes the most sense, feel free to use that. Now you can also do this using total costs and total sales. So you could take the total variable costs and divide it by the total revenue. And you would come up with 70% that way as well, or 0.7. So if you took, for our example, the 154,000 divided by the 220 would give you the contribution margin percent, or contribution margin ratio. That would be 70%. The same way. So what does that do for us? That gets us a little different formula. Now we take the fixed cost, we divide by the 0.7 or 70%, and we get the break-even point not in units, not in number of trips this time, but in dollars. So if we're wanting to know, okay, yeah, 55 trips, that's great, but what does that mean in sales dollars? Well, we could take 48 trips and multiply it by 4,000. That's one way to get it if we have the 48 already calculated. Or we can do this 134,000 fixed cost divided by 0.7 to get 192,000, which is all same as, and we'll give you the same answer as taking 48 trips times 4,000. Now, do we always just want to break even? Now, once we know what that is, and that's important information, obviously our goal generally is to do better than break even. We want to get to that point and then keep increasing our sales. So what if we want our profit to be 70,000? Whatever that target profit is just gets added to our fixed costs. So we take the 134,400 fixed costs, we add our 70,000, we divide it by 2,800 to get 73 trips. Now if we want to know what the sales dollars is, we can either multiply 73 times 4,000, or we can take the 134,400 plus the 70,000, right? again, adding in the target and then dividing it by the 0.7 or 70% to get 292,000. So you see, if we want to break even, we ought to sell 192,000. And if we want to make a profit of 70,000, we got to sell it 292,000. Now think about that for just a minute. Our contribution margin is 70%. So if we increase our sales by 100,000 past the break-even point, we should have profit of 70,000, 70% of that extra 100,000. Because after you reach break-even point, your fixed costs are covered, so they don't need to be considered in our profitability past that point. Because they're not going to change, right? They're going to stay as we increase our trips from 48 to 73. We're not going to have more fixed costs. They are going to stay 134,400. Okay, so if we want to make a profit, we want to see how we need to go about it, what our goal needs to be to reach that. There's what we have to look at. So, our two formulas summarized again, okay? Fixed cost divided by unit contribution margin, fixed cost divided by contribution margin ratio or percent. If you have a target volume, you simply add it to the fixed cost and do the same formula. Okay? Now, for those of us who like to picture this, okay, in a graph, okay, this is this dotted, dashed, I guess it is, line, blue line is total revenue, right? This is your volume, this is how many trips you go on, right? This is how much your dollar amount is, whether it be a cost or a revenue. So as we're measuring dollars for revenue, as your trips go up, it goes up in a perfectly sloped line, 4,000 for each additional trip. So at 100 trips, it would be 400,000. Okay? At 0 trips, it would be 0. Okay? So this solid blue line is our fixed costs. Total costs, I'm sorry, which includes the 134,000. That's where we cross the y-intercept here, 134,400, and it goes up $1,200 for each trip. So when we have 100 trips, it's going to be 134,000 plus 400 plus 1,200 times 100. So 254,400. Our break even is where the revenue and the total costs meet or are the same. Right? That's 0 profit. Above break even, as our sales go above the 48, then that's going to be a profit. That's what this area here indicates. And right here would indicate loss, because anywhere below 48, your revenue is going to be below your cost. Because revenue, okay, starts at 0 and goes up 4,000 for each one we sell. Costs start at 134,000 and go up only 1,200. So eventually, the revenue catches up. That's what break-even point says. So, when you think about this, we want to think about what is our cost structure in our business or in our piece of our business, because many times we want to look at it in pieces, maybe each product, each department, each factory may have its own cost structure, and that is how much fixed cost versus variable costs. The higher your fixed costs are relative to your variable costs, the higher your operating leverage is. So a company with lots of fixed costs is going to have high operating leverage. A company with low fixed costs and high variable costs are going to have low operating leverage. Now, the actual calculation of operating leverage is the contribution margin divided by operating profit. Okay? I'm not concerned about that formula. I'm concerned that you understand the difference between high leverage and low leverage, and that you remember this point. The more your operating leverage, the more dependent you are on fixed costs, the higher your break-even point, right? You got lots of fixed costs. It's going to take a lot of product sold to cover those fixed costs. So an example, okay, low level, okay, don't have a lot of fixed costs, right? 50,000. So their break-even point is 200,000 units. Their contribution margin per unit is pretty low, okay, because they have lots of variable costs. This has a lot of fixed costs and lots lower variable costs for the same amount of sales, right? So their break-even point, because of those fixed costs, is much higher, but their contribution margin is much higher as well. Now, let's see what happens when things change. If sales increase, and I could say the same thing for sales decreasing, but sales increase 100,000 for each side, then the contribution margin, there'll be an increase in profit of 25,000, right? An increase of profit of 75,000. Much more leverage, much more increase in profit, especially compared to where we were already. So that's what high leverage does for you. It makes it so that it's harder to get to break even, but it has greater profit potential once you get to break even. So you would also say that high leverage comes with higher risk. There's a risk you won't get to break even, but, and remember, risk is just the difference in our outcome versus what we planned. There's upside to that risk, and that is that you could have higher profits once you get past the break-even. All right, another calculation or tool, margin of safety. That's how much the sales volume we plan on making that's more than break-even. So a break-even is 50,000 units, and we plan to make 70,000, then our margin of safety is 20,000. So we sell 55 trips, our example here. Break-even volume was 48 from our earlier calculations. So our margin of safety is 7 trips. What about taxes? Now, sometimes we want to make sure that not only making a profit, but we're making a profit after we have to share it with the government. Not a big deal. Simply take the operating profit. Now remember, taxes don't affect break even, because at break even, you don't pay any taxes. We're talking about income taxes. If you have zero income, you pay zero tax rate. Okay? But when you make $1 of income and your tax rate is 25%, then you only get to keep 75 cents. All right? So to figure out how much your target profit is after taxes, you divide by 1 minus the tax rate. In this case, 25%, right? So our target profit was $25,200. We divide by 1.1 minus the tax rate, which is 0.75. If you put that in your calculator, if you take 1 minus 0.25, you get 0.75, right? So 25,200 divided by 0.75 equals 33,600. So if we make 33,600, we share 8,400 of it with the government. We get to keep 25,200, just like our target profit was. So that's the only adjustment you have to make if the problems say you need to calculate it using taxes after, or what the target profit is after taxes. Same thing with the number of units being sold. Okay, so let's just throw it all in. Fixed costs plus the target profit adjusted for the tax rate divided by the unit contribution margin. So if we want to make 25,200, which means we actually have to make 33,600, then share some of that with the government. Okay, then we divide those together. This is our fixed costs. This is our target profit adjusted for taxes. Divide by 2,800 equals 60 trips. So we've got to take 60 trips. All right, to make that target profit after taxes. And you can check yourself, right, by taking 60 trips times 4,000, setting up our contribution margin format income statement, sales minus variable costs, okay, 60 trips of 1,200 each, contribution margin minus the fixed costs minus the taxes of 25% of that number equals 25,200, just like we was our goal. All right. Now, let's extend this to a multi-product situation. You sell more than one product, in this case, more than one type of trip, and they have different different variable costs and different pricing. What they share, okay, is the fixed costs, meaning there is no way to separate the fixed costs. The fixed costs are there because of excursions and because of rafting, not because of one or the other. It would not make sense to do this if you could separate your fixed costs to those for excursions and those for rafting. If you could, you would do a break even for excursions and a break even for rafting using their own fixed costs. But where they have the same fixed costs, there's no way to separate them, then we have to do a multi-product analysis to get a break even point. All right. What we need to know is the selling price variable cost for each type of product, but we also need to know what ratio they are sold in. We need to know what's called the product mix. If we don't know how much of each we sell, then we cannot continue with our analysis. So, we know that the contribution margin for the excursions is $2,800. We calculated that it is for rafting trips of $400. We know that 25% of our trips are excursions and 75% are rafting. So we multiply 25% times 2,800 and add that to 75% times 400. Okay? And that gives us 1,000. This is the most helpful of our formula here. 25%. Remember, that's we sell 25% for our big trips, 75% for our smaller rafting trips. So now we have a weighted average contribution margin. We can simply take our fixed costs and divide it by 1,000, just like if it was a contribution margin of a single product. So 144,000 divided by 1,000 equals 144 trips. That's our break-even point now that we have two different products. Of that 144, 25% or 36 are excursions. 108 are rafting. That's 75%. So once we have the break even, we then multiply by the sales mix percentages to get how much is each product. They should add together. Now, if you round it a little bit along the way, that may not end up being around, a whole number, okay? And that's okay. We'll just round up usually in that situation. If we need to know that in dollars, okay, we simply take 36 excursions times 4,000, 108 times 500. Remember, we're multiplying by sales now to get our total dollars, total revenue in dollars for our break even. Now, if you want to look at it a little differently, you can figure out the weighted average revenue, the weighted average variable costs, or the weighted average contribution margin. So $1,000 from our last scenario, last calculation, divided by 1375. That gives us our contribution margin percent or contribution margin ratio. If you put a percentage on it, it's percent. 0.72 or 72.7273%. Again, we're starting to real life. You get a lot of things that don't round as quite as easily. All right. Couple of decimal places is going to be fine for most of these. Remember, we're estimating, so let's not pretend that we have things down to 4 or 5 decimal places very often on this type of scenario. So what are we going to do with that? We're going to figure out our break-even sales in dollars, 144,000 divided by 0.727273, 198,000. If you keep all your decimals, it'll probably be exact as what you got when you multiplied back here. Okay, 198,000. But if you maybe round it off to 73 or 72.7, then that 198 is not going to be exact. And that's okay. Remember, we're just estimating. Okay? As long as it's in the ballpark. So 144,000, break-even sales in dollars. You take the fixed cost, you divide it by the contribution margin percent equals your break-even in dollars. Now, what happens when you have things that are kind of like what we talked about in chapter 2, step fixed or step variable costs that change for various levels of volume? What may happen is that you may have more than one break-even point. Okay? So, for instance, this situation, for every 40 trips, Desert Adventure must rent a machine for $19,600. Whatever that cost is, okay? You'll be fine. The $134,400 is up to 40 excursions. But if you go over 40, you've got to have this additional fixed cost. Okay? Your break-even point was 48 before, but now with this additional cost that you found, I don't know if you found it or didn't realize it before, or it's just a completely different scenario, however you want to think about it. Okay? So now when you calculate your contribution margin here, that's 2,800, right? 4,000 minus 1,200, 2,800 that we've used all along. Multiply that by 48, and then you subtract out your fixed cost with the additional 19,600 fixed costs, right? Then you actually losing money, because before we were at break even, now we have an additional 19,600, we're losing money. So now we have to look at it, okay, with the additional break even, fixed costs. And so our break even is at 55. Now here's your problem. See, you can't get to break even before 40, right? Our break even with the old fixed cost was 48, and this new fixed cost kicks in at 40. So there is no way to break even below 40. Okay? So here is, you need to consider that when you're calculating your break even point. So now your break even point really, with the additional cost that you maybe had missed or didn't consider, is actually 55. And so you may find that will go up to 40 more, okay? And then there'll be another cost that might kick in, another step cost. So you're going to have some homework where you will have to consider what the fixed costs are for a certain range of volume, and calculate a break-even point. And then you'll have something that happens, an additional cost because of you reaching a certain volume, like this example here, that will be the same for a range of volumes. And then you'll have to use that fixed cost and calculate your break-even point a second, maybe even a third time. All right? And that's really just to incorporate more realistic understanding of what your costs are.